Treasuries are headed for their steepest weekly loss in 5 months. We were talking about that with Sarah Eisen. More evidence that the Greek situation can be managed. Less demand, at least today or this week, for so-called safe assets. Our next guest says it's a blip on the screen. Kevin Giddis is with us now. He is president for fixed income capital markets at Morgan Keegan. He has client assets under management of around $82 billion. Kevin, glad to see you. Welcome to the Inside Track. So who's right? Sarah Eisen, our reporter, just with us talking about this face-off with two pretty big heavyweights, right? A PIMCO on one side saying, look, Treasuries have had their day. It's over. And then on the other hand, you have BlackRock who's saying, look, you know, there still could be more to come, yields down to 2.5% even. Who's right?
It's kind of fun to watch these two heavyweights fight it out, but I would tend to side with BlackRock on this. I do think that there is so much uncertainty in the world. I mean, the Greek situation for now is settled, but that doesn't mean that
there's some clarity. It's far from being settled.
Yeah, exactly. Well, you know, they're going to get some money for a period of time. They have to then try to push through their austerity program. Now that they voted on it, now they have to get it to the people, and the people are resisting so far. So, and so whether that stops a contagion remains to be seen. So
that's an unknown, and
right.
As you're saying, that's going to keep investors at least still considering perceived safe assets such as Treasuries.
And then the end of QE2 yesterday, to me, it was symbolic, and so we had a nice sell-off because of the end of QE2. But the securities and the items that it was designed to benefit were stocks and commodities. And that's why we drove Treasuries to the point where they weren't no longer of value, I guess, for the investor. Those would be the likely ones that will be hurt. So you would likely think that both stocks and commodities would be hurt by the end of QE2, not be helped by it. So, you know, you take what's going on in Greece, the Eurozone, the weakness in the economy, the lack of inflation, a very liquid Fed. And I don't see a reason that we're going to see a spike in rates anytime soon. Now, we'll see volatility, but...
So, Kevin, you've talked about a lot of things that bond investors and traders have to digest. Can you rank these things in order of importance? In other words, okay, right now, the most important thing for the bond market is Greece, or it's the end of QE2, or it's the fight about the debt ceiling. Can you put those in order of importance?
Well, certainly right now the debt ceiling is an issue. Now, I don't think it's a major issue for the markets because these things just happen. I don't think there's any
yeah, we've seen it before, and most people think that a solution will be reached. But that said, I mean, we're getting pretty close to this August 2nd deadline.
Yeah, it makes for fun politics, I guess, but it's going to get done.
But it's not affecting the market, you're saying?
Not really. You know, the closer we get to August 2nd, obviously it will. So, but that's an issue. The biggest issue is the economy itself. Now that, you know, if there's safe haven trades that are going on in global events, those will take precedent. But all things being equal, the economy is the big issue. Now, if you don't have inflation, then you don't have a big worry for the bond market. That is the Achilles heel for bonds. So beyond that, we're going to look at the numbers themselves. Jobs are the key to that. A week from now, we'll get the jobs number. We're going to need a lot more than 150,000 jobs to move this economy forward more than 2%. So jobs, housing, inflation are the big issues, fundamental issues in the bond market right now.
Kevin, before we let you go, I just want to ask you, we've been talking about the possibility that the Treasury Secretary, Tim GEITHNER, may or may not be winding down his time in Washington. According to insiders, it seems like it's a possibility. What would this change for market participants?
Well, I mean, the uncertainty is the big issue right now. If Tim GEITHNER is truly looking to step down after a budget package or a debt package is in place, then it brings up a whole host of things. It's a short-term event. Especially with an election coming up. So whoever's coming in to be Treasury Secretary knows they'll have until November of 2012 and then may not have a job after that. So it'll be a difficult time, but the uncertainty is what's going to be the problem.
Kevin, we thank you so much. Kevin Giddis joining us right here. He is president for fixed income capital markets at Morgan Keegan.